morning, everybody, and thanks for joining Thompson Hine's Coffee Chat series. I'm Deb Strench. I'm a partner in Thompson Hine's Investment Management Group. This is our 11th Coffee Chat, and today what we're going to do is chat about a mutual funds conversion to ETFs, especially focusing on mutual funds converting into active semi-transparent ETFs. As you'll see, there's definitely a symbiotic relationship between mutual funds converting and a semi-transparent ETF. Joining me today is an impressive panel, two semi-transparent actively managed ETF innovators and the co-founders of Blue Tractor Group, Simon Goulet and Terry Norman, are with us. We also have an ETF and consultant and content marketing guru who has been around the ETF industry since its birth, Rich Curie. He's at Global ETF Advisors. So if you have any questions or comments during today's program, we encourage you to join the discussion by using the Q&A box on your control panel. We will address your comments as we move through the discussion, and we'll try to leave some time at the end to answer these questions as well. Of course, we can follow up to any questions after the presentation by email. So now, let me turn it over to Rich to get started.
Okay, great. Thank you, Bib, and thank you, everybody, for taking time out of your day to join us. Excited to talk to Simon and Terry about and Bib about the conversion of mutual funds into ETFs, and as they come onto the market and the operational side of it is getting better understood and locked down, we want to take the time to go in a different direction and say, what's the decision points that the advisors have to make when they want to convert into an ETF? Especially if they've never run an ETF before, what are they looking at? Where are the pitfalls? And lead that discussion for you. Simon and Terry have gone through that. They've had advisors that have taken on those decisions, so they're going to be the real experts on that decision tree. But the first decision has to be made is, what am I going to do with my strategy? Am I going to run it as an actively transparent, actively managed ETF or a non-semi-transparent active ETF? So Terry, let me start with you. Since advisors are considering these two different structures, the active versus transparent versus non-transparent, what are the considerations they need to be looking at? What are the most important decisions they're going to be looking at in that conversation?
Okay. Thank you, Richard, and good morning, everybody. That's a great question. And those managers who do convert look at a fully transparent ETF and see a number of attractions, not least transparency. Let's not forget, transparency has been one of the key attributes to the ETF success story today. So many managers wish to keep that because that also lends itself to a more consistent client experience. Market makers can see the risk they're exposed to, spreads will be tight, and that's all good news. And they don't have to pay a license fee to one of these semi-transparent ETF wrappers that we're going to discuss. So it looks a very rosy picture until you get into the decision-making process a little bit more into the weeds. And you've got to consider, why were these semi-transparent ETF wrappers proposed? Why did people spend time and resources on bringing them to market? And there's three things, really. One, to protect a manager's intellectual property. If you have full transparency, that intellectual property is there for everybody to see. To protect his trading strategy. Okay, we've seen and read about the ARC funds, how they're experiencing issues because the fund is so large, moving in and out of positions because of full transparency. In a semi-transparent ETF wrapper, that can be addressed. And then there's free loading. If you're a fund that's not trading much and perhaps trades once a quarter, and you're revealing your full portfolio contents to me every day, why should I even pay you to manage the fund? I can just replicate you myself, and I've not got to pay any fees. So when you get down to it, for the protection of the IP, the protection of the trading strategy, and to protect against freeloading, which generates revenues for managers, the other two protect shareholders against losses, you can see why all of a sudden paying those small basis point fees to a semi-transparent ETF wrapper is very attractive. And that's the decision our issuers have made, that they're prepared to pay the small fee to protect their IP, to protect their trading strategies, and to protect against freeloading.
Great. Let me just follow up with one thing. As you notice with me, I stumble a little bit. Non-transparent, semi-transparent. Is there a difference? Do investors care? Do advisor cares in terms of the nomenclature? How do you guys feel about that since you've coined the semi-transparent space?
Well, there's different levels of non-transparency. We're all bucketed in the semi-transparent, non-transparent acronym, but if you look at each wrapper, there's various levels of transparency offered, and the Blue Tractor wrapper is a highly transparent ETF structure because we've embraced transparency, and hopefully we can address this a little bit later on in the chat. But it really is a case for the manager how much transparency they're prepared to give the market, because you've got to find that balance between the transparency the market requires and investors require, while balancing that against the opacity the manager requires. And to give you an example, an ESG investor, for instance, would like to see what securities they're holding. They may not care whether they're holding 1,000 shares of one security or 900, but they want to know what they're exposed to. And that's where a highly transparent ETF structure will come into play. Other structures that use black box type techniques, they're no good in an ESG type environment. Not
hey, Richard,
type investors.
Yeah. Richard, if I can just interject one last thing, just people should be aware that even though these are semi or non-transparent products, you still will have to at least once a quarter, share your full portfolio holdings, just like a mutual fund does today. So it's not like you never expose yourself to the market, but it's just on a less frequent basis.
Gotcha. Well, thanks. And why I have you, Simon? We were talking earlier that it's the 1 year now that the non-transparent structures were approved by the SEC and launched onto the marketplace. Right. So what's the landscape look like now, a year out that these products have been in the market? And when you're doing this comparison, the transparent actively managed have been out for a very long time. So the apples to oranges is a difficult, it's a difficult comparison. But what are you seeing in the semi-transparent space a year in terms of issuances, AUM, ETFs, all that?
Sure, yeah. No, you're right. It's a great point. A year ago, almost to the day, April 5th, American Century launched their first semi-transparent product. And think about that environment. Think back to March last year. The VIX hit 80. People were panicking. Then, of course, people began to relax a little bit about in the capital markets and realized that there was a way through this. And the VIX began to go down, and hats off to American Century for taking advantage of it. So it's been about a year now. Richard, we're about just under 30 ETFs have launched in this 1 year period. About 10 issuers have launched about 30 products. AUM is just north of 1.2 billion. So it is growing, and I think your point's very germane that it's not fair to say it's apples versus apples, active transparent versus active non-transparent, because this is brand new and it takes time to gather assets, as we all well know. Spreads have been very good. These products have been trading quite nicely, around 20-25 basis points spreads, which I think goes a long way to assuage the concerns of some people that these products could not handle volatility in crazy markets. 20 basis points on a $25 NAV is about, about four to 5 cents. So that's pretty good, pretty good. In fact, two of the products that Blue Tractor has been behind, the Stance Active ESG and the Active REIT product from Alps, have been some days trading 1 to 2 cents wide. So, I mean, we're seeing some excellent dynamics here. I think this place has a lot to grow because right now the SEC has handcuffed the wrappers to be limited, Richard, to primarily domestic equities. There's no true foreign equities. There's no fixed income. There's no derivatives. So as those areas, as those investable classes get approved by the SEC, you're going to see a lot more innovation, and a lot more active managers come to market with some very interesting strategies. But again, it's a white space. It's ready to grow bigger and bigger. In fact, last week, Blue Tractor, we filed for a long short strategy, the first semi-transparent long short there is. So again, pushing the envelope, working with the SEC to expand this domain. So I think we're quite happy with what we've seen. 1.2 billion is not Kathy Wood-Ark numbers. I recognize that, but it's still in this environment an excellent first start.
Great, great. Terry, I'll throw it back over to you for a second. You mentioned some things earlier in your conversation, but if I had a client coming to you, trying to make this decision between, transparent and non-transparent, what would be the 1 or 2 features that your clients, as Simon mentioned, you got 2 of them on the marketplace. What were the things that they were attracted to the most in that non-transparent structure?
Okay. First and foremost, the transparency of the Blue Tractor structure. It seems, we're talking non-transparent here, but the Blue Tractor structure is a highly transparent structure. And with all these wrappers, and with a transparent ETF, transparency manifests itself within the creation unit itself. With a fully transparent ETF, you can see all the names in the portfolio and all the security weightings. With Blue Tractor, you can see all the security names, but the weightings are slightly different. And that's how we hide the secret sauce, the trading strategy, et cetera, et cetera. So they like that, particularly the ESG stance fund, where Bill Davis, experienced these ESG professional, recognized that his clients from SMA accounts wanted to know what was in their portfolios or in the ETF. So that was a big decision for Bill. And, same in the REIT space as well. They wanted their ETF shareholders to see what they were holding. But they also like the fact we hid their secret source, et cetera, et cetera. So with our structure, it's as close to a fully transparent ETF as you can get with this fine balance, unlike other structures that, other issuers obviously like, which use a black box, and the trouble with that, you only got to look at Viacom. If you're using decoy securities, etc., and your Viacom's in your ETF portfolio, but not in your creation unit, who knows what's going to happen to the difference between the ETF share price and the underlying INAV? It could go AWOL. So we believe, our structure gives the optimal balance, and that's what people like with our structure. And it can incorporate any strategy because of its transparency, whether it's small cap, large cap, some type of disruptor strategy, ESG, REITs. It's a structure that can encompass everything purely because of the high level of transparency. And that is the attraction for managers moving from mutual funds into ETFs, because it gives this client experience. And the wirehouses, one of their key considerations is not only their rules, you've got X million and track records, it's will our clients have a good client experience in all market conditions? And because of our transparency, the answer to that is yes. So they're all the things that bring our advisors to Blue Tractor as opposed to other structures.
Richard, if I can just add a couple more things, if you don't mind. The other key consideration right now for a lot of active mutual funds is, they're in a wrapper structure right now that unfortunately comes with capital gains issues. In a mutual fund, if you're an active manager, it's very difficult to avoid capital gains. And we all know what it's like to receive in the mail in November and December 1099 div forms for your capital gains dividends in your mutual funds, especially frustrating if your fund has gone down in value. So what they realized in the ETF space, there never is capital gains because of the ability of the ETF to use an in-kind exchange with an authorized participant and flush those gains out. And so one of the key issues for the semi-transparent space was that when we were initially approved by the SEC in late 2019, we did not have true custom basket relief, which is one of the key requirements in order to be tax efficient and get rid of the capital gains. That changed in 2020 when a few of us started getting custom basket relief. So now we are as efficient on the tax front as a fully transparent active ETF. So that's another huge advantage now for a manager when they think about this space now, because they can get rid of their capital gains exposure and have no problem now and be as tax efficient as a fully transparent ETF. And that's one of the key things now. I think you'll see advisors flocking towards this space.
Yeah, and with our structure as well, there are no new levels of administration. Our exemptive relief, we don't need an IOPV, which comes at a cost. So we don't need an APR, which again comes at a cost. So we're highly cost effective as well as highly tax efficient. And the most transparent structure there, as I keep saying, which I think differentiates us from everybody else.
Right. So let's switch gears for a second now in terms of, let's talk about the ETF structure itself. So you're converting from the mutual fund to the ETF fund. As an advisor, there's certain vendors, there's certain processes, your day-to-day activities around that are somewhat different than you have under the mutual fund wrapper, right? So Simon, can you talk about a little bit about that? And maybe since you talked earlier about spreads and how they're coming down, that capital markets function in an ETF is very different than what happens in a mutual fund. So what's that process for your advisors when they came in to learn and understand the vendors that are needed for the ETF space and some of those processes like capital markets that they need to become proficient in?
Sure. The acronym ETF says it all. I mean, most people, when they come from the mutual fund space, they know the F part, the fund, but the exchange traded part is new for a lot of folks. So that's the part that we try and help them understand. And, we say we hold their hand, but really we're just here as a consultant, a friendly party that's going to introduce you to people in the space that can help you understand that. So the thing that, you have to decide right away is, am I going to do this alone? Or am I going to sort of work with somebody else to help me issue that ETF? You can't do it yourself. You can hire people, you can buy the expertise, you can build up your own distribution, capital markets, administration. But for many smaller funds, they decide that the better play initially is to go with a platform, a white label firm that can hold their hand and guide them through the process. And Blue Tractor works with many of them. There's some excellent firms out there. I think of Ultimus, I think of Alps, I think of Foresight, UMB, Redgate, RBB, US Bank. These are excellent people and firms that can sort of walk you through the ABC of what you need to do. The second thing is, and you touched on it, Richard, the capital markets side. Do you have the chops to be in the markets every day, trading your portfolio, interfacing with market makers and APs? If you do, excellent. You're ready to go on that front. But if you'd rather not, again, you can outsource that function to trading some advisory firms like Vidant, firms like Alps Advisors, Pansera, Taroso. These are, again, excellent firms that can help you understand the capital markets and build your expertise and your relationships with the market makers and the APs. Because at the end of the day, these are exchange traded products. Market makers can make or break your fund. When I say make or break, it's how wide are the spreads. Are they going to be there in high vol, crazy vol markets, making markets for your product. You need to nurture these relationships. And again, Blue Tractor, we can help introduce you to these people, and you can learn how these products trade. The last big area is distribution. People have to understand that ETFs are sold and not bought. What that means is that you can't just launch a product and hope that people are going to find it on Robinhood or when they log into their Schwab account and just buy it. The way it really works, and you know better than I do, Richard, is that you have to go to the RIAs and the advisors and educate them on why this product is different, why it's important, and why they should care for their clients about this product. And that's a whole function in itself. You can't launch these products without a fully baked distribution plan. And again, at Blue Tractor, we will introduce you to people that can help you put together those plans so that when you launch with success. Okay. And finally, I think you mentioned, Richard, it really is a friendly, collegial industry, despite the fact that we're all competing. At the same time, we all want people to be successful, whether it's exchanges, NASDAQ, SIBO, New York, whether it's the big custody banks, the distributors shops, they're there to help you and educate you. And again, the first step starts with you pick up the phone or your email and just saying, how do I do this? And answers will be forthcoming. Don't be shy.
Great, thank you. Bill, let me finally switch over to you, and once again to thank Thompson Hine for putting together the webinar. With the conversions, right? Do the firms need to reorganize in any way? Do they have to set up a separate ETF group? Can they maintain the same trust? Just put an ETF on the trust? What sort of reorganization needs to be done here?
Sure, and I think why this is so exciting in the first quarter of 2021 is the evolution. Not too long after the first ETFs appeared and the SEC allowed them, people wanted to convert their mutual funds to ETFs, and they got a big fat no from the SEC. Even if they said, "Hey, we'll go to a shareholder vote, let them vote on it," the SEC said no. And then what happened was the years and years later, after all the no's, we started to see applications for semi-transparent ETFs. And then right after that was the 6011. So that really showed that the SEC was open back to innovation, the innovation they allowed to create the ETF in the first place. And so a couple of fund complexes filed with the SEC to convert, but then the trick was, how do you do that under the federal securities laws? And the registrants in the SEC had to work that through. And why we're talking here in March, or now April, but in March, at the end of the month, there was the first successful conversion. So to answer your question, there are two paths you can go. You can simply take your mutual fund and convert it into an ETF. I use the analogy that, let's say you want to go mountain biking. Well, you can use your road bike and modify it. So you got to go and look at your governing documents, your registration statement, some things that are not crystal clear on how you have to rework it to make it happen. Or back to the bicycle analogy, you can just use a mountain bike. So you can ditch your mutual fund and reorganize into an ETF, and that happens all the time. It's pretty seamless to shareholders, and essentially you're taking your mutual fund assets and cash and moving it over into a newly created shell. So that's called a shell reorganization.
Great. So one of the questions we have from one of our participants was sort of exactly on that frame. First of all, what is the time that it takes to do that conversion? And during that conversion, you said it was seamless. So is there no point whatsoever where investors don't have access to the fund, whether it's a mutual fund or ETF? Is it offline and at any point?
Right. So this is a new developing area. The first couple conversions, Guinness and Dimensional Fund Advisors, they went the shell route, the reorg route. Now, key was that they didn't get shareholder approval. They were able to convince the staff that if the ETF is functionally the same as the mutual fund in terms of strategy and portfolio managers, et cetera, we should be able to rely on a rule called 17A8 and not have to get shareholder approval. And I think that helps a lot on the timing. It's not clear necessarily if directly converting versus reorging into shell, one is faster than the other. But before you even get to that point, as I think everybody's been talking about, there's some legwork and prep work you have to get through to put yourself in a position to convert.
Great. And with mutual funds, there's share classes. So if you're converting a mutual fund into an ETF, can you take all those share classes and shut them down and offer one ETF? Or is there any restrictions around certain share classes being converted or not being converted?
Yeah, right. So that gets into the planning stage, and you really, either way, you have to recraft your mutual fund. And one thing is to shed classes, because there are not multiple class ETFs. That's not permitted. Setting aside a kind of a quirky approach that Vanguard got a number of years ago, where it has a mutual fund class and an ETF class. So however, you do that, you distill it down to one class, the class that doesn't have a front-end load or a CDSC or an active, 12B1 fee, because those structures aren't permissible. A defensive 12B1 plan is fine. And there are other steps you have to take as well. And it should be noted, as Simon and Terry said at the beginning, not all active semi-transparent ETFs are permissible. So you're either may have to adjust your strategy in the mutual fund you're thinking about converting, or it may just be impossible to convert it because the strategy is for example, holding international securities that don't trade the same time as the ETF shares. That's currently not permissible.
Gotcha. All right. Well, thanks. I thought we only have a couple minutes left. So, Bib, I'll pass it back to you.
Yeah. So thanks, Richard, Terry, and Simon. Great chat. I know we could have gone a lot longer, and maybe there'll be a setup for future coffee chats where we can dig in a little more to these topics. So I just want to say that concludes our program. Feel free to, again, ask any questions, send them by email, and I will highlight our next coffee chat, which is Wednesday, April 14th. My colleague Owen Wilson will be discussing cannabis. And I can't recommend a coffee that goes to cannabis, sorry. But really how the SEC is kind of handling cannabis with investment products. So to register for future coffee chats, visit the events page on the Thompson Hine website. You can also see some of the past coffee chats we've done. But again, thanks everybody, including the audience, for your interest in the program. And please feel free to provide us feedback, and have a great rest of the day.
Thank you.
Great. Thank you. Appreciate it.
Thanks, Bill. Thanks, guys.